Rajiv Batra, head of Asia Equity Strategy at JP Morgan, joining into the show right now to talk about what he's making of the markets right now. Rajiv, hi, morning. Good to have you on the show as always. Rajiv, do you think the proposed GST rationalization along with the US tariff uncertainty is all baked into the price rise in the markets right now? And more importantly, the GST rationalization, good news?
Morning, Aisha. Thanks for having me today. So it's a mixed bag because you are presenting me both tailwind and headwind at same point of time, where we have a good news in form of GST rationalization and most awaited, you can say, the fiscal support we were waiting for that is finally arriving. But at the same point of time, tariff uncertainty is still remaining in place overall. So it's kind of a mixed feeling which market is going through, and hence you can see, despite having a plethora of a good positive macro data coming out during market hours yesterday, the overall index didn't move up much. Why? Because market is still under stress. What is going to happen on August 27th, whether 50% tariff is going to become a reality or not. So you can say that looking at the market absolute performance year to date, and most importantly, relative to the rest of Asia and emerging market peer, where India is lacking close to 25% for the last 1 year, is discounting most amount of negativity. But as I said, near term, there could be market worrying about the volatility, geopolitical uncertainty, but from medium term, long term to perspective, fundamentals will prevail, and hence my corporate earnings, GDP growth of the country will be paramount important. So if that starts coming back on the picture, then I don't think so we should worry too much about the tariff uncertainty for India.
But in the interim, Rajiv, and you rightly put it, the market is in a little bit of a confused tug of war kind of situation, if I can really call it that. Do you think the headwind impact is bigger than the tailwind, Philip, which is purely domestic in nature?
Look, headwind impact, if we will take into account this tariff, it could be in range for around 40 basis point to the 80 basis point to GDP overall. But it also has to take into account whether that tariffs remain in the place for entire year or for the longer time horizon. The big question mark is, what if within next 2 months or 3 months it start rolling back and the numbers start going lower, and at the same point of time you also start getting same amount of a tailwind or bigger tailwind coming from this GST cut side. So as an example I would like to throw is, if 25% tariff today is a reality, which is a 40 basis point drag on GDP growth, on the same side, if GST rationalization is giving a 60 basis point boost over there, if this 40 basis point headwind moves away in 3 months' time and only 60 basis point remain, then your net accretion on GDP growth could be 100 basis point. Now, is market discounting that? No, market is not discounting that. Market is not even pricing that you have a net positive impact even of a 20 basis point too. So we are currently too much focusing on that 40 basis point or a 80 basis point downside impact rather than thinking what the tailwind could provide. And this is not something new with India. We have seen over the last 2 to 3 decades, whenever the geopolitical uncertainty approach, we start forgetting about the fundamentals and quality of the market. And that's where our job as a market participant will be, to bring people towards the neutral line rather than taking them to the extremes.
Absolutely. But, as an investor, one's got to be prepared for the extremes too. Well, the market itself is pretty neutral for the longest time. But Rajiv, while at an index level, we're only about 1,300 odd points away from that all-time peak, right? Yeah. Which we clocked in last year, September. Assuming the worst case scenario, that there is that 50% tariff by month end and it continues to be a drag, as in there is no resolution for some more time to go. What's the worst case scenario and what's the best case scenario for the index? Should the positivity from GST rationalization begins to kick in, alongside the earnings season, or rather the festive season?
Looking at the recent reactions from market headlines over there, we have been receiving a lot of headlines over the past few days, where comments have been made about Russian oil imports coming from the US policymakers, or people watching how the peace treaty going through between Russia and Ukraine. But if we would have seen the reaction from Indian equity market, it has been fairly muted. Like, it has not celebrated big time the positive news also, but at the same point of time, when the worrisome news is also hitting, it is not going down that significant enough. No doubt on the actual D-Day, if this particular news hit, it will be interesting to watch the entire day action. Like what you start with as a downside when that 50 base is like 50% tariff is hitting, and how you close that particular day. We have to appreciate that the Indian domestic investor is becoming quite smarter. They are using this kind of an opportunity to get more into the quality sort of kind of a name. So taking that into account, I will take that it will be a higher volatility event, but will it become a base case for 3, 5, 10 years perspective for most of the investors' pitch book? I doubt.
All right. Hi, Rajiv. Morning. This is Shrishti. Always a delight to interact with you. But Rajiv, help us understand that which sectors do you believe can really participate in the rally going ahead? Because earlier I was wondering whether or not you will make any changes to your 30,000 bull case target for Nifty. But I don't think that there's any changes made for now. But which sectors do you believe will participate the most? Because you have been bullish on autos, hospital, defense. Anything else added into the list?
No, so looking at the overarching theme for this year and going into next year, even if US is not slipping into recession, but global growth slowdown is upon us, where largely it is coming from the US, where JP Morgan expect this year GDP growth forecast to be in the range of around 1.6% for US, and next year 1.5%, a significantly below the potential growth mark of around 2.5%, 3%. Taking that into account, we will need to be deploying more into the domestic demand for India as well as other emerging markets and Asia, and try to be a bit cautiously optimistic on exporter. So domestic demand over exporter is our broad-based theme which we are following in our allocation. Within that, for India, the preference is consumption over capex. This is a theme we have been pushing since February this year, when we saw slowly and steadily that country was pivoting towards supporting more consumption. That has been the weakest spot for the country for the last 5 years or so. We saw fiscal subsidies being given, that followed with the tax rate cut for middle class, and now potential GST normalization, which we are talking about. So that pivot is going to help consumption. So taking that into account, my sectoral allocation is precisely in line with that, where we are overweight on financials, consumer staples, discretionary except auto. We are overweight on healthcare, hospitals, and power and defense. Where we are underweight on is IT, pharma, and auto sector. Recently, we even upgraded materials to overweight, but on the export side, IT, pharma are the key concerns for us.
Okay. Rajiv, hi, morning. This is Nehi also joining in. So those are some of the sectors that you're liking right now. And I also couldn't help but notice real estate as one of the sectors that you like, mentioned in your latest India strategy note. Give us a sense of what you're seeing when it comes to that sector, because we're getting mixed updates from developers on ground, wherein some are saying that demand looks intact, some are saying it's only luxury demand that is intact and affordable is in the trenches. How are you positioned when it comes to this sector?
No, so in case of a real estate sector, after kind of a great performance, which we have seen for the past 3 to 4 years in a row, post this kind of a excessive monetary policy tightening along with the balance sheet size reduction from RBI, where balance sheet growth was 4% and country's nominal growth was 11%, real estate sector was bound to get slowed down, tapered, or the mixed kind of a commentary which you are hearing is a reality after that kind of a tightening. But taking today into account, where you have seen 100 basis point of a repo cut, 150 basis point of CRR cut, the policy is tilted toward again more on easing overdrive. Taking that into account, the mixed kind of feeling or the sentiment which you are getting into real estate, give a quarter or two, you start getting even the positive commentary out. We have seen in the past that whenever your mortgage rates start hitting 7 kind of an handle, that usually is like an inflection point for demand for mortgage loan coming and good for real estate sector also. So we remain hopeful and optimistic, and festive season or demand season is also upon us, with rates being lower, like your durable sectors and stuff. Even real estate sector will also tend to benefit. Hence, this is the reason why we remain overweight on real estate space.
But Rajiv, you have also debated in the past that India will remain to be one of those expensive market in terms of the valuation, while the outperformance with respect to the emerging markets right now is still to take place. But the other fact of the matter is, Rajiv, that the FIs are not finding that much of an interest in the Indian markets. You have been interacting with a lot of global investors, I believe. Help us understand what are the top two questions they are asking about India right now.
None. Top two questions are always growth, number one, and the second one is what is happening in the policy zone. So each one of them are getting fully addressed at this juncture. The bigger worry till end of November last year was how longer this twin policy tightening will remain in picture. So that question is now fully getting addressed after the Independence Day speech from Prime Minister, where we have started talking about GST normalization. Post that, we can see, like, as I've said, monetary policy easing plus fiscal easing in tone is settling down the nerves of foreign investors that, okay, India's policy regime shift has started happening, looking at reforms again, looking at easing cycle again. Where the questions still stop and we fully don't have factual answers to justify right now is on the growth. So even if we can say that looking at our models, looking at coming 2 or 3 quarters, growth will start reviving. Investors wants to see it factually, that your growth is in kind of a double-digit handle in earnings term as well as nominal GDP terms, and macro data points are only going up north rather than staying flattish or down. So investors till, like particularly my foreign investor, don't smell a double-digit growth handles on earnings. They will not get warmed up to India story again. Remember, investor never comes to India for valuation. They come to India for sustainable earning growth, which India provided from 2020 till almost 2024. As this growth started receding in India, that's where you can see outflow started happening and foreign investors' ownership kept on coming down on India. So growth and policy are the two key things which I've been most time questioned on.
Interesting. Rajiv, just want to get back to your point on pharma. Why not pharma? I mean, I understand that, the sector itself is trading at expensive valuations, almost a 26x PE. But other than that, do you not believe that the domestic pharma and the generic story will continue to do well, and healthcare as a segment, more importantly?
No, I 100% agree you with, like, in the whole healthcare space, our most preferred space is hospitals, where we think there's a structural demand. And as India's GDP per capita and medical insurance penetrations keep on increasing, hospitals should keep on benefiting from 3, 5, and 10 years kind of a length. Similarly, in case of a domestic pharma too, where the issue can start arriving is more from your US generic related names, where one concerns on top of your head is, like, if tariff, like what after 50% that can India should be worried about. It's Section 232 investigations, in which even pharma sector is also included. The big question mark over here is, if that overhanging sword is there, do we want to give a higher valuation to this particular space? Should we remain significantly over position, which I can look from the books of foreign investors as well as the domestic mutual fund investors? That question marks leads towards that going into such event, is it not prudent enough to take profit off the table? Because we have seen 40% outperformance from this space over the last 3-year period. And with the way things have panned out for India and most of the sector for last 1 year, it's prudent to remain on the sideline and revisit them once the event gets over. Top of it, earnings which the recent quarter concluded, have not been that great enough for the pharma sales. It was a kind of a lackluster, or you can say underwhelming. So taking that into account, plus Revlimid going off patent over here as such, and hence the earning contribution will also decline from 13% to 1%. So that makes us a bit concerned on this space, and hence we believe it's right time to take profit off the table, but remain only in selective spaces like, as you mentioned, some domestic pharma name and hospitals, and like almost a zero position on US generics.
Okay, and Rajiv, of course, the next big event to be watched for closely is going to be the Jackson Hole Symposium and Fed Chair Jerome Powell's speech on that. While you are positive on financials, help us understand what the cascading effect could be back home based on what the commentary is, and what are you expecting to hear this time around?
The topic this time in Jackson Hole is quite interesting. It's on the labor and labor supply overall. So it will be interesting to watch what the final outcomes come from there, whether non-farm payroll, which is the most like a debated topic of discussion over here, whether 100,000 kind of a run rate monthly should be considered as the accepted one, or it will be brought down to 50,000 as a normalized one over here as such. If the commentary from that side is too hawkish enough, and that start putting a doubt in minds of the bond investor that come September 17th, there should be 50, 25 or no rate cut, then that will have a kind of a risk on impact on the entire global equities, especially right now where market is still highly pricing in 25 basis point rate cut on September 17th. So the risk of tone will definitely impact our cyclicals also on ground, particularly domestic cyclicals, where we have been seeing people are increasing positioning over the last 3 to 4 months.
But Rajiv, let's also touch upon the defense pack, because there's always a debate going on that a lot of it is already in the price. The valuations are not that attractive. But what's your bull case scenario when it comes to the defense? Because you have been sounding bullish on this space for a while now.
No, it has been a structural theme for us, and we believe this theme will prevail, especially post the recent uncertainty which India has seen during the month of April and May. We believe the incremental investment and capex will keep on growing up in this particular sector. And top of it, with the scenario which we are in, that everyone is own for own in the global market side, and hence this is the reason why most of the countries are increasing their defense budget and expenditure. Even under that scenario also, most of the foreign you can say multinationals and giant who want to expand their wing, they will also try to forge a JV or try to do some mergers and acquisition in this particular space, and this industries can keep on growing as such. For now, I still believe that considering national security into account, plus top of it, the global scenario which we are in, this is a one such sector we should be playing from next 5 to 10 years perspective. And top of it, people have a lot of contemplation on whether there will be delivery in terms of an execution from Indian defense company, plus will earnings match the kind of the valuation that got built up over the last couple of years. That concerns have started receding of late, and most of the conversation which even I had with my foreign investors also, even they are opening up and even like asking that whether we believe that India defense industries is trying to get to the global standards right now. So taking overall holistic view on this space, I think it's better to be overweight or a structural buy on this space rather than trying to play cute and trading in on this space that's one day you are an overweight and then you go on the sideline. So I think that trade may not work. You need to be in this trade for a good, reasonable amount of time.
Rajiv, what are your thoughts on the Alcob industry though?
It's a premiumization play in India, and as we have seen in the past, like the premiumization trend is upon increase beyond, like as I've said, where people take good care of their health and hospitals are benefiting beneficiary, and same side you can say premiumization also benefit because of a rising GDP per capita. This is the part of the cycle we have seen in other EM also, who went through this from 2,500 GDP per capita to 3,000 and above, how the different plays came out. So Alcob was the one particular space. In other countries also we have seen got benefited when GDP per capita moved about certain level. And top of it, as you can say, more saving also coming in people's hand, either by the tax rate cut or even by normalizations of sales and the GSTs and thing, that will also help your Alcob space too.
Absolutely, it will. In